Hello friends, today I'll tell you something many traders keep quiet about. You've probably never heard of the 3-5-7 rule. Honestly, I didn't even know what it was when I first started trading. And even when I heard it mentioned somewhere, I thought it was meaningless. But let's get this straight. This isn't some trend thing traders come up with to make themselves look smart. It's risk management, without which you have no chance of preserving your deposit. This system is a rule developed from practice, formulated by traders themselves when realized that discipline is the only thing that separates a successful trader from a failing amateur. The essence of the rule is never risk more than 3% of your capital on a single trade. You must clearly understand that if you enter a trade, you cannot afford to lose more than 3% of your deposit. This isn't because someone said so, but because years of practice have shown that it's precisely at these levels that a person survives a series of losing trades and remains alive in the market, not burned out. If you risk 10%, 20%, 50%, that's it. Consider your account at zero. If a series of losses occur, next, don't keep your open exposure greater than 5% of your total capital. The trick is that you can't open a million small positions, each worth 3%, and then wonder why, when the market goes against you, your account is down 20%. The rule is all your open positions combined shouldn't risk more than 5% capital. And this actually works because automatically limit the number of trades you can have open at once. And finally, try to make sure your winning trades yield at least 7% return. It's like mantra. You repeat to yourself every time you sit in front of the charts. The idea here isn't literally go out and make exactly 7%. The point is that your winning trades should yield more than your losing ones. If you exit with 1% or 2% gain, that doesn't cover subsequent losses. You simply treading water. The goal is to extract winning from the market that are worth it. Of course, you don't have to follow this rule every trade, but if you start, you'll see how the number of panic entries, ill-considered trades, and all toxic thoughts that kill your deposit faster than you think decreases. The rule isn't just about numbers, a structure that helps you systemize your approach to the market. When you trade without a structure, you're essentially playing in a casino. Only the bet isn't $1, it's your deposit. This raises the logical question. Why haven't I heard about this before? It's simple. Many traders don't like to talk about the intricacies of risk management. The 3-5-7 rule isn't about making $1 million in a week. It's about staying in the market for years, not days. You know, I've been personally applying this rule for several years now. And the initial effect wasn't that I started earning more. The initial effect was that I became less nervous. When you know your position is within acceptable risk, you don't jump at every move. And when you start living by this rule, trading becomes more boring. So to speak, less adrenaline, less wow moments, and less hysteria. So what do you do if you want to earn more but can't increase the risk? Increase your deposit, not your risk. Don't increase your interest rates. Don't break the rule. Just work over time. This rule won't automatically make you profitable, and you need to say out loud, it doesn't guarantee profit. It ensures you don't ruin yourself. There's a big difference. Risk management is a defense mechanism, not a money-making strategy. It's boring and time-consuming, but it's the only proven path that I, as a professional trader, accept. Because boring trading is controlled trading. Discipline and consistency are more important than adrenaline. The market doesn't pay for emotion, it pays for consistency. The 3-5-7 rule doesn't limit your growth, it limits your mistakes. And these are fundamentally different things. Many people fear that if they risk only 3%, they'll never make a decent profit. But capital growth occurs through distance and not by increasing risk. You can break the rule once and get lucky, but the market will eventually take its toll. Now, let's apply all of this to reality. Because while it sounds beautiful and logical and clever, most people have a question in their heads. How can this even be applied in real trading, where everything is fast, the chart is moving, the timer is ticking, and you make decisions in seconds? We select the Australian dollar and the CHF OTC asset and see that we've bounced upwards from the 100 EMA, but we're in an uptrend. Therefore, we precisely bounced from the 50 EMA, and now we've bounced from the 100 EMA. We have no reason to reverse downwards, and the previous candlestick attempted to do so but failed. Therefore, we entered the trade upwards and took our first profit. We select the Australian dollar and the USD, the United States dollar, asset, and see that we've reached the previous low, that is the RSI level of 30. Based on these values, we can confidently move higher, which we did, and took our second profit. Next, we'll select the New Zealand dollar and the US dollar OTC asset. We see that the market is severely overbought, trading well above the 70 RSI, so we'll try to move lower and return to the previous price levels. We enter a short position and take another profit. Let's move on. Now, we're entering the CHF and the GPY asset. We see that we've broken the previous high, that is we're already trading above it, but we've also broken through the 70 RSI. So we can confidently enter another trade down and take the profit. That we've applied this rule in practice. Many might ask a logical question. Why do people blow their deposits? And here we come to the point where the 357 rule seems clear and logical. Everyone nods their heads, but for some reason, it doesn't work for most people. This isn't because the rule is bad, but because people break it at the most crucial moments, often without even noticing. For example, they break the rules after a series of trades. Traders tend to increase the risk after losses in order to return to the profit more quickly. Furthermore, there's a confusion of concepts. People think that if they trade a small volume, that's risk management, but this is not true. Risk isn't the trade size per se, but it's the ratio to the deposit. You can have a small deposit and risk 20%, and that would be considered aggressive. Or you can have a large deposit and a risk of 2 to 3%, and that would be considered reasonable. The percentage is more important than the amount, and until a person realizes this, the 357 rule is just a number for him. Next comes the ignoring the 5% total exposure clause. People think, I'm not violating the 3% per trade, and they simply don't take into account the fact they have several open trades in a row, which are essentially dependent on the same market movement. As a result, the market makes one sharp move and all positions are immediately hit. And finally, misunderstanding of the meaning of 7%. Many either ignore this percentage entirely, perceive it as a rigid target for every trade. Both are extremes. The point, as mentioned earlier, is to ensure your winning trades outweigh your losing trades. When this understanding is lacking, people either take profits too early, hold on to losing trades for too long. Both scenarios are equally destructive. This rule doesn't negate analysis, strategy, or experience, nor does it replace training. It simply ensures that your mistakes don't cost your entire deposit. It provides a framework within which can develop, experiment, and learn without being thrown out of the game after a couple of unsuccessful days. To sum it all up, the 357 rule isn't about quick money or pretty numbers, but about stopping, fighting the market and starting to work with it systematically. It doesn't make you a perfect trader, but it gives you a chance to stay in the game long enough to become one. And if you truly want to grow as a trader, not just chase emotions, then understanding and applying these rules isn't an option, but a necessity. I hope this video was helpful. Be sure to subscribe to the channel and like it, and I will see you in the next video.